And when FIIs come back, generally they tend to stay for long. Can we be reasonably sure that in the next few months, liquidity will not be a problem? Since FIIs are back, promoters are not selling, IPOs have dried up. So, at least on the liquidity front, can one be constructive?
I'll give the same answer that I always give. You are not going to learn much about what is appropriate to do in the market by looking at the actions of others. Whether those others are foreigners or whether they are locals or whether they are somebody else. So I think it is a pointless issue to keep looking at are foreigners buying or are they selling. I think it's more important to consider what is within your control, which is within your domain, which is your asset allocation, and secondly, where are we in the valuation cycle. I think continuously trying to figure out who will buy and who will sell is a waste of time, and I would not recommend that as an investment strategy or process to anybody. And I'm obviously talking about people who are focused on investing for the very long term, and that's the target audience that I have in mind when I make this. If there is somebody who trades in and day out, even for them, I would say find some other way. Trying to track flows is not the helpful way to actually trade the market. Your other point about the self-balancing nature of the marketplace, I'll just spend a minute on that, which is to say, see, when there is lot of demand for shares, somebody has to provide you those shares. And I think people miss the point when they keep looking at FPIs are selling the shares. No, the supply of new shares comes from the issuance of new shares. And one of the good things, because we want India to grow and we are excited about India's growth prospects, is that we have a capital market which takes the money from the people who have money to invest and gives it to the professionals and managers and the entrepreneurs who actually run businesses who need capital to grow their business. Otherwise, how will the economy grow if there's no capital available to the entrepreneurs to invest in their businesses? So that is where the supply of new shares comes from. So in the last year or two, we have seen a very aggressive IPO pipeline. We have seen aggressive QIPs from companies. And in some cases, because many companies in India have been promoted by PE funds and VC funds, after the company gets listed, as promoters, they no longer desire to be promoters, so they come forward and they liquidate their entire shareholding in the secondary market. So it is that supply of shares and that supply of secondary shares from people who have no continuing stake in the business, like PE funds and VC funds, which meets the demand arising from people who buy equities directly or give it to mutual funds like us, who then go and deploy it in equity. Now, this is a self-balancing mechanism, because when prices go up a lot, you find a lot more activity in the IPO market, QIP market, OFS market, PE, VC funds coming to sell down. Look at the last 2 months. The minute the market went into a sell-off, the entire IPO pipeline, QIP pipeline, OFS, PE, VC sell down, everything comes to a halt. So this is a natural balancing mechanism where when prices are down, when there is uncertainty, this transaction between those who wish to invest and those who wish to supply shares comes to a natural halt. Now, if it shuts down for a very long time, that is also not good for investors, because that means there is no capital available to businesses and entrepreneurs. Then where will future growth for the economy come from? So this is a balancing mechanism, and that is the way I would look at the stock market. It is not a Ponzi scheme in which somebody is trying to buy ahead of somebody else, buying shares in the market. That is not what the stock market is about. It is the market for allocation of capital and a transfer of resources between those who have the money to the entrepreneurs who need money to invest in their businesses.
Thank you, Vetri.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.